a lot of guys look at P&Ls as, just a slab of numbers. There's all these numbers on there and they're hard to read. They're really not, but it's having them sorted out the right way and understanding what goes where. So we're going to look at that, then we'll take time to stop to grab a coffee or a drink, and you guys can have a look. We can even share screens if people want to look at Xero or things, and I'll pause recording. If not, we can just talk about it hypothetically as to how things should be allocated. So let's look at the segments of a P&L, right? Your first thing up the top is revenue. Yeah, how many dollars did you make? I love round figures because I can work them out. So I'm just going to assume, I've been using this a lot today for these videos I've done for you guys. Revenue, $1 million total. Now, you might have 3 or 4 things in here, that are different revenue streams, or that you've broken them down to different things. For us, it was generally carpentry labour, carpentry materials. Yeah, we also had hourly rate. We'd had things like work cover income, which seems odd, but if you had someone off on work cover, you had to pay them, and then you got reimbursed by work cover. So that became income coming back in. Apprentice bonuses, when we got paying for an apprentice getting signed off at the end of their time, or you get a bonus for signing up once they stay with you for a year. That's other income that we would put in there. So you might have a line item for that, but it just comes in and it's one thing at the top. It's usually pretty small. Revenue. Not the amount of revenue, that's not small. The amount of the total sheet, if you're looking at a sheet that's this big, I'm trying to make sure my hands can be seen because I talk a lot with my hands. And Maddie pointed out before that I tend to be up here. And when I go into this nice little circle, that I then do all these hand gestures that no one can see. So I've got to remember to take a step back and be here. So when you've got a P&L this big, of this P&L, this much of it is revenue, this tiny little bit at the top, right? The next thing for you guys, this will be the biggest amount of money on your sheet other than revenue, but it's often not a big area. This is what we call direct costs or variable costs. You've got other names, but those are the two that you refer to the most as. Direct costs, cost of goods sold. It's the things that change as you do more or less work. For most of us, it's going to be labour and materials. Whether it's fuel in your truck for Ren, whether it's cabling for Shauno, whether it's plaster for Jazzy, materials are materials, right? It's materials. Hugh, who can't get timber, so let's assume you're going to get a tin snip, Hugh, because it seems you can't get timber these days anywhere. Even I can't do home projects. I'll go to Bunnings, there's nothing on the shelf. I was getting desperate when people would buy curved stuff from Bunnings. The more work you do, the more materials you buy, the more labour you have. Whether it's subbies, whether it's apprentices, you can stand guys down. If you're quiet, you can hire more guys if you're busy. So they vary. That's where that term variable costs. So often it's easier to remember them as variable costs, because if you can think of them as being variable, it helps you know when you've got a cost and where you should be assigning it to which part of the P&L. So this part here or this next part here, which we'll get to in a sec, does it change when I do more or less work? Do you have a question, Hugh? Sound like you're unmuted to ask something. Are you cool?
Yeah, no, we're good.
Sorry, I just thought I'd pause for a sec because I tend to talk a lot. So everything that goes in here is going to be your wages, your subbies, super. This is for wages for on-site staff, by the way. If you've got admin team, it's not in there. Your super, for your on-site staff. So we always used to have 2 categories because we had admin and we had on-site staff. So we broke out the amount of work cover we paid for on-site versus office staff. We broke out the wages into 2 separate categories. We had actually 2 separate pay runs to make it even easier. The other thing I'd want to see in here is your on-site wages. So what do I mean by that? Let's pick that round figure again. You're going to pay yourself 100 grand a year, and you work out that you're going to be on site 60% of the time. All right? You're going to be at home in the office 40% of the time. I don't care if you're on site for 8 hours a day and then at home for 5 hours a day quoting. That's not 100% of the time on site, right? You're working a ridiculous number of hours, but the amount of time total of your work week, whether it's 40 hours or 100 hours, the total time of your work week that you spend on site doing invoiceable work versus the amount of time that you're spending doing all the admin quoting shit, right? If it is 60% of the time, then you should have 60K up here. 40K is going to be down here in overheads, admin, right? So, what we do is then, this is where people start to get, because until this point it's easy, right? You get a total variable costs. Often your accountant will set it up as total cost of goods sold, total direct costs. Here, let's say it's 700,000. Yeah? What we do here is take our total revenue less our total variable costs, and we get our gross profit, which in this case would be $300,000. If someone ever says profit, just the word profit with nothing attached, they do not mean gross profit. What most people think of, 95% of the population think of when you say profit, is net profit. It is the very bottom thing on your P&L, the bottom line, right? That's where that wonderful American term comes from, get to the bottom line. Because, what matters? How much profit, being net profit, did you or didn't you make? Gross profit is only halfway down. It's what are your direct costs? So it's your gross profit there. I hope that's making sense. So your gross profit margin here is 30%, because your gross profit is 300 out of $1 million, right? This is a measure of efficiency, because why do it? Why care about it? Why not just fucking get to the bottom line, right? Why are we going through the effort of figuring out a partial, silly, middle of the road profit when what we really care about is how much profit we make at the bottom? Because it's a measure of efficiency. If you go and quote $100,000 for a job, especially when we're paying hourly rate, it's great for the builder. They win the contract to do this house, to do this building, to do whatever it is. They then go and get all their different trades and they get a fixed price quote. Every one of us has guys on hourly rate. So we quote a job and then we can make more or less money depending on how long those guys take to do that work, right? So what we do is we go, well, let's look at it. Let's look at if we've done a $100,000 job and we had to spend $70,000 on wages, then we've made our 30% gross profit. If they went faster, if they made 30%, if they made, instead of 70, they went 10% faster, and only cost us $63,000 to pay them, that's $7,000 more in our back pocket. That's $37,000, 37% gross profit. So we use it as a measure of efficiency because it varies. That term, I'm going to keep coming back to it, variable costs, right? Because it varies with efficiency and with productivity. The faster you guys are working, the more aligned they are as a team, the more lit up, the more A players you've got on there, and the more they're just smashing it out of the park, then the more work they're going to get done for the same cost. So your efficiency goes up. It varies, up or down, as they get lazier, slower, things go wrong, right? These next ones are fixed costs, which are generally called overheads. That's what you usually see them as on a P&L. It's everything else. I'm going to stand a long way back. If you've got a big sheet this long, 2/3 of your sheet is usually overheads. Your revenue's a few lines at the top. You'll have 4 or 5 lines of wages, and then this will be things like $100 in postage. It'll be insurances. It just goes on and on and on. There's freaking lines for everything, right? It just seems to go on forever. I'm going to delete this so it doesn't seem to go on forever. But when you look at it, literally, there's just so many lines on your P&L that are in this overheads fixed cost column that your accountant or your bookkeeper will prepare for you. They're fixed because the concept is that they don't rapidly change if you do more or less work this month. You still got to pay your bookkeeper to reconcile your books, whether you've not got work on this month or whether you've got oodles of work on this month. You've still got to pay your rent. And by it may not be an office, it may just be you write off a third of your mortgage or your rent at home as a home office. You've got to pay your phone, your internet, your costs that don't change are still going to be there regardless of whether you've got a bumper month or a crappy month, whether you need more subbies or less. Yeah, it's fixed. So while it will change over time, because if you double in size, you probably need another admin person. You might need another estimator. Your insurance is going to increase because it's based off turnover, but it doesn't change fast. It's fixed for the longer term. So all of these costs here go to make up your overheads, right? So let's say out of that, it's $200,000, which it's, try to do it because that's not how it would appear on a P&L. There would be another line here like this, and it would be total fixed costs or total overheads, right? And that's 200,000. So we would always work out that as a percentage as well. So 200 of a million is 20%. That makes a big difference to your profit, and there's little things there. This is where in the fixed overheads, it is where the saying, take care of the cents and the dollars will take care of themselves comes from. I don't know if it really does, but I'm just going to pretend it does. It is so easy just to spend a little bit more. Like zero costs you $75 a month. It can be more depending on how many staff you've got on. We've got, for this business, we've got 18 different software subscriptions that we use. For the co-working business, there's like 9. Between door entry softwares and payment for Stripe and the stuff for people to book meeting rooms and things. There's all these different things, and you just go, I'll just get one more. Like even for this call, I was using 4 or 5. Each of those I pay a monthly subscription fee to, and you just go, it just clocks over on the card, and there's so many of them, you never notice it. Like 2 or 3 times a year, I'll get my card, I'll wait until a point where I don't need that business card for a bit, which is, I gotta say, it's hard, but you can always do, cardless withdrawals if you need it. I will cancel my card and say it's lost. Why? Because the bank will post me a new card with a new set of numbers on it because I lost it and someone may have picked it up when I've just put it in a shredder. And I'll get all these emails. Hey, your card's not working. Now, I'll say, I'd forgotten I'd signed up for a free trial of that. I got one today. Like I got a thing ordered from Kogan. It was something that was $280 if you sign up for this 14-day free trial of their Kogan Plus membership or whatever. Then it was only $130. I'm like, fuck, of course I'm going to do that. I forgot to put a reminder to cancel within 14 days, so they charged me $49 for the membership. I'm like, but I don't want that to roll over next year. I don't need a Kogan membership. So all those things that just clock up, those little bits add up in your fixed overheads. Little bits here and there that just tick away, and they add up. So you want to keep an eye on what that is. Early days, if you're running at 20%, that's right. We ended up running between 12 and 14% as we got bigger. This is where going, do I need a bookkeeper at $80 an hour when I can get someone offshore at $8 an hour? It's what can I do to make that better? We've done exercises that we'll talk about as we go through this program where, right, if I'm going to bring that down, can I go through and can I take 10% off every single line on my fixed overheads? Yeah. We had a factory in Thomastown at the time, and we called them and said, can we get a discount on the rent? I'm like, fucking what? They sent us an email and explained why. I sent it and explained, tough times, industries in the downturn, blah, blah, blah. They're like, no, but what we'll do is we will not give you the rent increase that's due next year, at the end of the 12-month term when the rent goes up. It's only by CPI. So we only saved like 3%, but it's something. Wouldn't have got it if not for asking. I know of people who've gone and switched over to VoIP systems from phone when VoIP was first coming through, when it wasn't standard to have NBN everything through the internet, and they're going able to change and save huge amounts. So how can you save money on there? But it's a longer term prospect. It's not saying that changes quickly because overall these are fixed. Right? Then we get to the magic bottom line, which is your net profit. You'll hear it termed EBIT, which is earnings before interest and tax, or EBITDA, earnings before interest, tax, depreciation, amortization. Don't worry about it. It's just profit. So here, it's $1 million less the 700,000 in variable costs, less 200,000 in fixed costs, which means you've made $100,000 in net profit, right? Why is this important? Because what we're talking about here is gross profit. Gross profit being a measure of efficiency, right? So I need you guys to understand where and why costs go where they go so that you can work out what your gross profit is, and so you can see on your P&L where you can make changes and where we can go and assign things in a sec to make sure that our guys on site are covering the costs that we've got in the office.